Most people believe the biggest risk to their investments is the market. A crash, a recession, a sudden drop in prices. Because of this, investors spend enormous energy trying to predict what markets will do next. But something quietly surprising happens in the real world. Many portfolios are not destroyed by markets. They are destroyed by something far more subtle. So this raises an important question. What is the silent risk that quietly destroys many portfolios, even when the investments themselves are good? To understand this, we need to step back. Because investing is rarely just about choosing assets. Stocks, funds, property, those are simply tools. What ultimately determines the success of a portfolio is something deeper. Structure. The structure surrounding your investments. Now here is the part many people miss. A portfolio does not exist in isolation. It sits inside your financial life. And if that structure is unstable, the portfolio becomes vulnerable. Consider a simple example. Imagine two people holding exactly the same investments, the same index funds, the same allocation, the same long-term strategy. On paper, their portfolios are identical, but their financial structures are very different. The first person has very little liquidity. Most income is already committed. Mortgage payments, car finance, monthly obligations. Unexpected expenses appear regularly. Savings are limited. Their financial life depends heavily on continuous income. Now imagine the second person. Their investments are identical, but their structure is different. They have liquidity. Margin exists. Unexpected costs can be absorbed. Their lifestyle does not rely entirely on constant income. From the outside, the portfolios look identical, but beneath the surface, the structures are completely different. And this is where the silent risk appears. Because when pressure enters the system, behavior changes. Now imagine the market falls. Perhaps 25%. Perhaps 30%. This is not unusual. Market declines happen regularly over long periods. The first investor immediately feels pressure. Bills continue. Income uncertainty appears. Liquidity is thin. Suddenly, the portfolio is no longer a long-term strategy. It becomes a source of emergency cash. Assets are sold, often at exactly the wrong moment. Not because the investor lacks intelligence, but because the structure could not support patience. Now consider the second investor. The market falls, but liquidity exists. Margin exists. The portfolio is not required to support immediate expenses, so behavior remains calm. The strategy continues. Over time, markets recover. Compounding resumes. The difference between these two outcomes is not investment selection. It is structural resilience. But something even more interesting appears here. The silent risk is not market volatility. Volatility is normal. The silent risk is forced selling. When investors are forced to sell assets during stress, compounding is interrupted. And once compounding is interrupted, long-term wealth can be permanently damaged. Pause for a moment. If markets dropped by 30% tomorrow, would you feel calm? Or would selling begin to feel necessary? Your answer does not reveal investment knowledge. It reveals financial structure. There is another layer many people overlook. Liquidity. Liquidity simply means accessible capital. Cash reserves. Emergency funds. Money that can be used quickly. Liquidity is often criticized because it produces low returns. But liquidity performs a critical structural role. It protects your portfolio from you. Because when liquidity exists, investments can remain untouched during stress. Without liquidity, investors are forced to convert long-term assets into short-term solutions. And that is where portfolios quietly collapse. Now there is another important element. Psychology. Investing is not purely mathematical. It is behavioral. Humans experience fear, uncertainty, loss aversion. When financial pressure increases, even rational people behave differently. Decisions become reactive. Long-term plans are abandoned. This is why structural design matters. Structure supports behavior. Now imagine a portfolio supported by three quiet conditions: margin, liquidity, low financial pressure. These conditions create something powerful: patience. And patience is one of the most valuable assets in investing, because compounding requires time, not constant decision-making. Without patience, compounding cannot function properly. Now here is something worth reflecting on. Many investors spend enormous time searching for the perfect investment, the best performing fund, the next emerging opportunity. But the greatest threat to most portfolios is not investment selection. It is structural fragility, the financial environment surrounding the portfolio. Pause again for a moment. If your income stopped for 6 months, would your investments remain untouched? Or would selling them become necessary? That single question often reveals whether a portfolio is truly long-term or quietly vulnerable. This is why financial architecture matters. Income stability creates margin. Margin allows liquidity. Liquidity protects investments. Protected investments allow compounding. And compounding quietly builds wealth over time. Once this structure exists, something interesting happens. Investing becomes calmer, less dramatic, almost boring. And ironically, that is often where the best outcomes occur. Because in the end, portfolios are rarely destroyed by markets alone. They are destroyed when financial structure forces investors to abandon patience. This is the silent risk. And once you understand it, investing begins to look very different.